Have you cashed out your retirement portfolio yet? If you're like me, just kind of holding steady. And in today's video, we're going to be looking at the top mistakes to avoid when we're seeing a market sell off. Now, when we start thinking of March, investors are really grappling with a bunch of different things, including the possible on and off of the tariffs, what inflation is going to look like, how the economic forecast of growth is looking for the United States. A lot of investors are also concerned about a possible recession in the future, but hold tight. When we start looking at some of the biggest tech stocks, shares tumbled 10, 20, some even 30%. Tesla is even 50% off of its recent high, which is kind of crazy. And then we couple that in with the Federal Reserve, which is really worried about cutting interest rates. What is it going to do to keep an inflation on target? And what is the economic growth exactly going to look like? Now, when we start looking at your portfolio in retirement, you're seeing red across the board. This is the point where either you can buy more because it's at a discounted price, you can dollar cost average in like we've been doing all along, but it is especially important during the market declines to keep an eye on your long-term goals. When we think of investing, we're talking 5, 10, 15, 20-year time frame. We're not looking at what happened in the last 20 days, because when you start looking at 2023, 2024, we had some pretty solid gains over there. Don't fall into the trap of thinking that you can time the market when it's virtually impossible. Now, when it comes to investing, we want to cover 5 top mistakes that people do during a sell-off, just like we're seeing right now. Starting with number 1, don't become a short-term trader. When the stock market starts declining, when you start getting wrapped up in the latest news, which is literally everywhere, including YouTube, tick by tick, market traders are watching it. We're seeing it go down. A lot of people are saying the sky is falling. It's going to be the end. We're going to see a recession. The stock market's going to have a correction, which we fell in today, but it's going to have an absolute 50% reduction. 401ks are going to get wrecked. There is so much negative news out of there. You have to keep in mind, and really top of mind, why did you start investing? What is the long-term goal? For me, it is retirement. It is about that debt-free journey that we have right back here. Being able to utilize a retirement portfolio that I do not have to worry about money, and I can also build that generational wealth. This is where you resist the urge to become that short-term trader, because of course, if your portfolio is down 5, 10, 15%, when you sell it, you are locking in that 15% loss that you just had, which means if you didn't predict this current sell-off, there is no reason. And what makes you think that you can predict exactly what is coming next? Now, the second one, don't chase the recent winners. Now, when the market's falling, a lot of people will buy, and it's kind of nature, they will buy things that are green. They will go ahead. If you look at your portfolio and you see a bunch of different stocks or ETFs that are all red, you see a couple that are green. A lot of people will shift their money and move it. You're just moving out of what you knew was your long-term portfolio into something that you're kind of chasing it. Don't chase the winners. When you start but selling when it's going down and buying when it's going up is what most people do. It's kind of crazy. Over 60, I think it was closer to 70% of Americans will buy and invest when the market is going up, which of course is counterintuitive. Think of if you're buying something in a retail front, if you're going to the grocery store and only buying things that are more expensive than you were last time you were there, really doesn't make a lot of sense. May feel better in the short term, even if you're making money getting those dividends, but you're better off sticking with the choice portfolio allocations that you had, rebalancing those allocations as the price change versus selling out of those in the entirety. Remember, stocks are part of a very long-term plan. When we start looking at the S&P 500, when we start looking at averages, it returns roughly 10% on average. So if you're selling out, if you're eliminating that portfolio, you are effectively eliminating the 10% growth or the rebound growth that we see within the next 3 months after we see a negative market. Now, third one we look at, it's not the time to panic and sell everything. Again, when it comes to money, when it comes to investing, you have to take your emotions out of it. It is about having a lot of stability, but watching a portfolio decline can be very tedious, very taxing, very detrimental to well-being. It has an emotional response when you watch your hard-earned money that you saved, that you invested, the strategy, disappear within a few hours or even a few days for some people. But this, you have to fight this strong urge to sell just to keep the portfolio from declining even more. But that would be a mistake. When we start looking at the rebound, investors who can really, and they do get out of the market until things settle down, there's a chance that they're going to miss the big recovery days that we talk about. And the recovery can be just as swift as the decline, we can see it go down for a number of days or even a number of weeks, and then see 1 or 2 days where we have some solid gains that almost puts it at an even keel. Selling can be very harmful when it ends up being the right call for a period. If the stock continues to fall after you sell it, you feel great about your decision. It's nice to watch the portfolio stabilize. It really starts to level off, but the problem is you may feel so good that you're not losing any money that you don't go back into investing, and now you're stuck paying higher prices than you sold if you want to get back in. Now, the fourth one, and this is one that I am super guilty of, don't check your portfolio constantly. I check my portfolio about once a day, maybe twice a day. Following every move of the market, constantly worrying, watching the news, doesn't lead to sound decisions. You have to make sure during a market sell-off, even when the market is absolutely ramping up, if you're constantly checking it, there's probably signs that you're worried about it, or you're going to make an emotional decision to pull out your money. Again, remember the bigger picture. Remember exactly what you're investing for and why you're investing. These are the reasons why we usually see really big up days after we've seen a decline. It's also worth reminding yourself how a 401k works. When you think of the market being way up, when you look at the market being way down, 401k is dollar cost averaging into funds, meaning that every week, every 2 weeks, when you get paid, doing those contributions with the matching contributions in the 401k is the most logical way to do it, especially in a down market where you're buying it within that 401k. That is much cheaper. And the final one, cash is no place to hide. There are a lot of people that I've seen that have said they have moved all of their funds to cash when the market is in a free fall. Actually, lousy holding as a long-term investment. Even as a short term, you might set your cash on the sideline, waiting for the market to go up. But like I said before, then you're going to be buying the market when it's starting to go up, losing purchasing power with money. And if you're sitting on a lot of cash in a traditional savings account, if it's in a checking account, the Federal Reserve with long-term inflation at 2.8%, like we said, that means your cash is going to be worth less over time. As consumer price index increases, as inflation eats that away, it's going to make a difference. Now, the only thing you want to keep in cash is your emergency fund, and also looking at just kind of the regular bills. When I see people that are sitting on, $20, $30, $40, $50,000 in cash with absolutely nowhere that it's invested, it's not in CDs, it's not in high yield savings account, it's not in anything. If you're holding cash in a portfolio and it's earning probably 4% or less, or beating out that 2.8%, you're going to be losing money, especially if it is not invested in the market, because it has the ability right now to buy at a very, very heavily discounted market. So bottom line, guys, sell-offs are normal. If you look at the history, go back 10 years, 20 years, 50 years, whatever it is that you want to look at with the S&P 500, you can avoid the mistake by slowing down, thinking about the long-term investment strategies that we have in place. 3 ETF portfolios. Volatility is part of investing, knowing how to handle it properly and really getting over this and seeing those long-term returns is going to make a big difference, again, in that longer term when you know exactly where your goals are. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about the decline in the market. And as always, thank you guys for watching.